Hey, everybody. This week on the Business Owners Corner, I want to talk about a specific type of retirement plan that I think is underutilized, but is a great opportunity for a lot of businesses. It's called a cash balance plan. Retirement plans are categorized, or retirement plans fit into one of two different categories: defined contribution and defined benefit. Your traditional types of retirement plans like 401ks are defined contribution. And what that means is that the IRS mandates and sets rules around how much we can contribute to those accounts. But there are no rules that govern how large those accounts can grow. A defined benefit plan is the exact opposite of that. There are no limits surrounding how much a business could contribute to a defined benefit plan. There are only rules governing how large it can grow. And it's based on a whole bunch of actuarial assumptions the IRS gives us that I'll save you all from right now. A cash balance plan is a really good fit for profitable businesses whose owners already have a 401k plan, but they're trying to defer more of their income and save money on taxes now. The way it works so for example, if you already have a 401k plan, you and your employees have the opportunity to defer your salary into that plan, and it's not taxed from an income tax perspective now. The money that you put in there can be invested and grow. You take it out later, you pay tax on the distributions then. The business might also make some kind of contribution. You could match employee contributions, salary deferrals, including your own. There might be some kind of non-elective or profit-sharing contribution where you put in X percent, maybe 3% of your employee's compensation. You might have discretion over whether to make an additional profit-sharing contribution on top of that. The cash balance plan is a good opportunity to give you more deferral. So in other words, allow you to put more money away, the business more money away, tax deferred every year. It's technically a defined benefit plan. And the way it works is if you establish one of these plans, the business agrees to put in X percent of every eligible participant's compensation every year. So let's say that you're the only employee, you make $100,000, and the plan agrees to put in 5% of your compensation. Well, every year you put in $5,000, right? The plan also specifies, so unlike a 401k plan where those dollars are invested and the value goes up and down related to how the market performs, in a cash balance plan, the plan actually specifies the rate at which those contributions grow. So it might be 3 or 4 or 5%. Let's say it's 5% to make the numbers round. Well, that means that in year one, the business is going to be obligated to put in $5,000 into the cash balance plan. And then in year one, the amount that you as the employee is entitled to is going to grow by 5%. So if year one you put in 5,000, in year two you put in another 5,000, but year one's contribution grew by 5% that's stated in the plan. So your total, the amount that you are entitled to, has gone up to $10,250. So logistically, you set up the plan, the business puts cash into it, it's invested in a way to where the returns should match what the stated intentions of the plan are. And so every year, if the market crashes and the $5,000 that should have become $5,250 instead has fallen to $4,500, well, in year two, you have to make up that difference with another $5,000 contribution plus the $750 that you lost from market performance. You can draw it up in a number of ways that are congruent with your intentions in the business, but it can provide for a bigger tax deferral. It allows you to put away more money tax deferred through the business than just a 401k plan. And a lot of professional services businesses are great fits for this. Now, let's fast forward. When you reach retirement age, you hopefully have some cash in an account to your name as the employee. When you hit retirement age, you're entitled to that amount either as an annuity going forward or a lump sum distribution, maybe into an IRA. So it's a defined benefit plan in the sense that the amount that you're entitled to as an employee or participant in the plan is defined. But the amount that you pull out of it is defined. The amount that you put into it fluctuates based on market performance. And then when it comes time to actually take the money out, you have the option of pulling it into an IRA and managing it on your own, as opposed to being forced into an annuity or steady stream of payments through retirement. It gets a little bit complex, but suffice it to say that if you're a high income business and you're trying to put more money away tax deferred, you might want to kick the tires on a cash balance plan because it allows you to maximize your deduction.